Good afternoon. We are here at a joint committee hearing with the House Appropriations Committee and the House Committee on Ways and Means. It is Friday, January 16th, 2026, just after 1 o'clock in the afternoon, and we're delighted to have our economist here with us, Tom Cavett, and his assistant, Daniel Lee, to talk about the economic revenue forecast and update that we heard this morning at the Emergency Board. And so with that, I think I'll let you all introduce yourselves and talk to us, and then we'll be asking questions later on, but we're delighted to have you here.
Great. I'm Tom Cavett, for those of you who don't know me. This is Daniel Lee. So thank you all, first of all, for doing this jointly. In the past, sometimes we've had meeting after meeting after meeting, and divide House and Senate into separate ones, and pretty soon we don't know what we said to who, when, and all the rest. But the other thing is, I think the purpose of this is to have time to do question and answer. Many of you, I think, have seen the Emergency Board proceedings and had documents circulated, with some time. So I'll give a brief overview, but I really just want to throw it open to Q&A so that things you're interested in, we can respond to. This is one of the really forecasts that has the least amount of change from the last forecast we did of any that we've done in the last 30 years. It's a function of both the fact that the estimates to date through December were very, very close. And there's no major fund that's off by more than 1%. And that's also unusual. And with all the chaos and tumult and everything of the last year, it's kind of remarkable that really the economy performed pretty close to how we expected it would, and revenues are also pretty close. Doesn't mean that uncertainty didn't, represent challenges to the economy, and that everything's as expected, and that next year's not going to have any additional tumult and surprise, but that we're pretty close to where we expected to be, and so we're not making drastic changes to the forecast. So in the forecast period going forward, there are a couple tables on pages 6 and 7. The tables on page 6, first table at the top, and I don't know if Sorcia, you can get the page 6 on the thing there, if they can show it. But
We also all have papers.
yeah. So so there's a year-to-date.
You said page 6, Tom?
Page 6, yeah, page 6. Right. Year-to-date revenue dollar, and then the January versus July dollars. But the table on the following page 7 shows the difference between this forecast and the July forecast as a percent. And you'll see between fiscal 26 and fiscal 29 of the three large funds, education, transportation, general fund, none of them will have a greater variance than plus or minus 1% in any given year between fiscal 26 and 29. So there's not a whole lot happening. In healthcare, there were some pretty significant changes to the provider tax, and that's going to have a material impact, obviously, on revenues, and those flow through to the general fund. So when you look at the dollar changes on the preceding page, well, that actually doesn't even have 31 because we're doing comparisons. But if you get out, okay, there's a chart on page 26. Maybe I'm moving too fast here.
She was having some technical problems.
Okay, good. So on page 26, there's this chart showing the change in the revenues, by fund, by year. And you see the general fund by 2031 you know, is minus 35. Oh, that's fiscal 30. Okay, minus $35.9 million. 24 of that, 25 almost, is just the hospital provider tax. So the changes to the rest of the general fund are pretty minuscule.
Can you clarify the provider tax?
It's just again, Nolan Langwell is doing that particular part of the forecast. They're in the healthcare section, we do the cigarette and tobacco tax forecast, but Nolan
I guess I'll
does
say Nolan's
those.
not here, so I'll just say
Yeah,
that
it's-
the bulk of it is that we're federally required to reduce the rates. It's not a reduction in the base.
It's part of the Reconciliation Act. Yeah, required that the rate, yeah, it's not a policy decision you guys made.
Right.
Nor is it a loss of revenue to the hospitals, right? It's just a thing.
It's a loss of revenue to the general fund.
That's right.
And we heard about that when when Ashley from AHS came into our committee earlier this week, and it was going to be $17 or $18 million a year for 5 years, you know, increasing by that amount for 5 years. So at the end, it was around 87 million, 85 million.
Right.
By the fifth year, we'd be losing 85 million a year from where we are.
Right, right. So just, you know, so you know how that works with the whole forecast. We're doing all the forecasts for the general fund categories, except healthcare, where we only do the cigarettes, all the transportation, all the education fund stuff. But the healthcare items are done by Nolan and a counterpart in the administration. Yeah. So net, just not a lot of change happening. It's not like there weren't some issues. There was a lot of weakness in corporate income tax through the first half of the year, particularly in November and December. It was pretty high refunding, and we were concerned that that was something that might be a problem going forward. On page 8, which is hard to see the page number because it's a chart that we usually just use for internal purposes, and it prints to the whole page. Oh, Sorcia's got it up there too. That's corporate income tax revenue quarterly, and it's seasonally adjusted, which isn't normally how the data are expressed in the state. You know, if you look at federal statistics, they're almost all seasonally adjusted annual rates. Here's what's happening in the economy, GDP, whatever it is. We don't usually present revenue statistics that way, but that's the way we analyze them. We seasonally adjust all the data, and that's what we end up modeling. And when you do that, you can also identify underlying trends and things. But you can see from all the movement on the red line, even at a quarterly level, how volatile that revenue source is. Yes, sir?
What caused the big spike in revenue after 2020?
Tremendous increase in asset values, tremendous amount of federal infusion of money into the economy, and a lot of categories, you know, were swept up with that. Also, the ability to keep corporate profitability high, even during times of very high inflation. So there was a capacity to pass prices on for the most part. So
it wasn't an increase in corporate capacity?
no, not some dramatic increase in corporate capacity, no. We also went from our apportionment schedule, we adopted single sales source apportionment, and that ended up being a net positive. Wasn't clear when we were doing it. It's a very hard thing to analyze, trying to do company by company and guess what's your tax bill under this and that. But it has created a much broader base.
So does it reflect an increase in tax rate for corporations?
Probably the effective rate, but we have no way to tell because it's a completely different set of taxpayers. But it is more like a national set of taxpayers. So that's why there are charts on the next few pages on total corporate profits. Just because when we had this decline, we had a lot of refunding. And we went through the refunds individually to look at them and see if we could find any patterns in what was causing that. And a lot of it was backward looking. A lot of it were events that took place 1 year, 2 years, even 3 years ago. Returns that were being reviewed by the tax department, and then the settlement ended up with a refund. Not a lot of it was current. There was some slowing of payments and some absorption of carry forward money that might have been due to uncertainty in the economy, but there was nothing obvious. So that's why we're not, and then we looked at national corporate profits and saw it through the third quarter. They're looking really strong. So there's no reason to think that's really, the bottom's going to fall out. And what we saw in those 2 months is problematic beyond some lost revenue. But yes.
I think you made a comment about significant refund from corporate taxes as well, like breaking.
Not refund singular, but refunds plural, yes.
Plural, yeah, refunds
Yeah,
plural.
yes, there were a number that were substantial, and that's why we were digging into them individually to try to find out what's happening. You know, is it a company that all of a sudden is seeing a drop in demand, drop in profitability, drop in likely future obligations, tax liabilities, or is it something else? And so that's what we were looking at. And we did not find a pattern that suggested that
So there's a
there's
variety of reasons for that.
variety of reasons, and a lot of them backward looking. If they were based on current conditions, that would be different. So, you know, we had a very limited period of time to produce this forecast, 6 fewer days than last year. That's a lot of condensation of analytic time. We could have done more work in corporate, and we're still looking at stuff the tax generated for our use in this, but we couldn't find anything that would cause us to think this is systemic. We're looking at something like headed to the recession kind of thing. I think that it's just as likely to bounce back, and you see those kind of wild swings you can get. If you had some of those earlier drop downs, you might be panicking then too. So we didn't see reason to panic. And we had some offset on personal income where it was running ahead of target. And that's been a bit stronger as well. So net is pretty close to zero.
Tom, as you dig into the corporate over the next few months, and I'm sure you'll be in touch with Pat about that, we might want to have you back into Ways and Means if you do start to discover some patterns. And all
Yeah,
that.
if we see anything
Absolutely.
that
I imagine
isn't,
you'll tell Pat right away, but yeah, we'd love to have you in.
well, yeah, we would communicate that
Great.
directly. Yeah, you guys would know about that.
Thank you.
So I've got Tom has a question, and maybe if people have questions, just raise your hand and I'll keep the list going.
Okay, thanks.
Tom?
Can you help me read, in particular, this chart here, but also the one on page, well, the previous page, whatever that is, page 8. But this one here, this one with all the red on it, are those actual dollars or are they inflation adjusted? So when I see something like
Current dollars.
1980, it's what's that?
Current dollars,
Current dollars.
not inflation adjusted.
So the figures that are on the right-hand side are just, okay, so it's
Left-hand
dollars.
side, billions of dollars.
Right. Okay, and so, and then when, on page 8, can you just help me read this again from, so from 2020, there was a massive influx of corporate income tax revenues. A lot of that could be, as you mentioned, could be because of the infusion of COVID-related relief dollars being churned into the economy.
Yeah,
And then the current one sees this almost the same kind of precipitous drop on the way. But where is the sweet spot of considering what the new normal is?
yeah.
Because if these were injected dollars into the economy for good reasons, when we're starting to deal with austerity budgeting again, and we're
Yeah.
trying to make believe it's 2019 again in terms
Yeah.
of how we budget stuff, how do we regard this there's now this downslope of income in terms of how we're going to do our business over the next several years.
Yeah, well, that's why we do a 5-year forecast. It's not part of the statute, but once we have these models set up, it's not that hard to do. So we started doing it just, you know, as a gratis thing. And Appendix A at the end of the whole thing has all the forecast tables out 5 years, not just 2 years. And that doesn't get voted on at the E-Board, but it's so that you have some perspective on what it'll be. And it would have corporate revenues dropping to 223. Whoops.
Is this page 46, or what page are you looking at?
Yeah, let me find appendix. It's at the very end, so appendix A, the last, starting at the back. And you can look at, for general fund, available general fund, which would be table 1, on page 47. And that would be, you see, corporate income in fiscal 2025 was 272.6, would drop to 223, but then go back up like 248, 261, 275, 287, and up around 300. So it's not going to like fall back down like it was before. Its corporate profits are likely to remain fairly robust at a historically high level, but not show the same kind of growth they did over that really unusual period.
Okay, thank you.
Yeah. There may be some fall off, you know, AI investments are very expensive, and the companies that are making those investments are taxpayers of note. And, you know, it's not like they have big presence in Vermont, but they have very big profits. So even a teeny apportionment share can be substantial. The cost of AI investment will be expensed, and when that's expensed, the profit will go down for these entities that have been extremely profitable. So if they don't develop AI products that are generating revenues that are feeding into profits, getting them a return on that investment quickly, there could be some erosion in profit margins, even among these Mag 7 kind of companies. And that would be noticeable. So, you know, there are things that could happen that could erode corporate profits overall. And of course, any kind of a downturn or recession, corporate profits usually turn quick and hard. They also bounce back pretty quickly. So.
No, you're good,
Okay, any other questions on that? There are lots of other smaller things happening. The consumption taxes were pretty stable. Sales and use is just a fuzz ahead. Meals and rooms is a little bit below. Purchase and use is a little bit ahead, but those are essentially in line with what we're seeing in the retail and consumer sectors. There is a bifurcation of consumer demand that we're seeing in the economy in general. It's sort of called a K-shaped economy, where, you know, those at the top are doing really well, and those at the bottom are doing poorly, and in many cases getting worse. Right now, 49% of all consumer spending is made by households that are in the top 10% of income. So that's an extremely lopsided sort of thing. And a lot of that capacity and willingness to spend is a wealth effect from what's happening with the stock market. Those same class of people are heavily invested in the stock market in general, disproportionate share of ownership. And so there's a lot of free spending in one part of the economy, and another part, people are tightening their belts. You're seeing vehicle repossessions go up. You're seeing a lot of credit stress at the low end, and at the same time, the high end's doing great. So you'll talk to your constituents and there'll be some that are saying, what do you mean the economy's bad? It's never been better. And others will be saying, what do you mean the economy's looking great? It's terrible. I, can't afford things and I'm not getting wage increases and following. So both of those are true. But we're seeing lower growth there. There's, I mentioned the meals and rooms has suffered a little bit more than we expected from both weakness in discretionary spending in middle and lower income households, but also by foreign visitation boycotts, particularly Canada. And that borne out in the latest statistics. In the briefing in early December, we looked at stats through November. Take another month, it's pretty much the same picture, but the visitor centers immediately proximate to Canada are down like 35%, and that is a
You
cause.
have a question?
Well, if you look at your chart there with the recessions, 1991 recession, I had a restaurant 3 months in Canadian.
Okay,
40% of their customers were Canadian.
yeah,
The exchange rate went to 40% overnight. We lost 40% of the customers. Last I checked a few months ago, I think the Canadian exchange rate was still up around 40%.
yeah,
And that there will stop people from coming down.
yeah,
And it's not a boycott phase. We're going to do it.
yeah. Well, and you add that to negative sentiment, which is a real thing, and it affects other countries too, but Canada in particular, and it can be devastating. Yeah, yeah. No, that's a good point. Yeah, I didn't do exchange rate stuff, but yeah, we can talk about it at some point too. Maybe the next round we'll get deeper into that. That's an issue too.
Nobody rushed to help us, like we often rush to help other industries.
Yeah.
Kill
Yes, that's right. That's right. Yeah.
Okay.
Okay. Let's see, what else is of note? Transportation funds are really pretty close. A lot of the changes there were pretty minor, but we did make a change to the assumptions about fuel efficiency, fuel use, and effective fuel efficiency through more EV adoption. With the current policies of administration now, that is de-emphasizing EV conversion and green energy in favor of fossil fuel extraction, we're going to see more gallonage consumed in the state. So there's going to be more gas gallons and probably lower prices for gasoline. The net effect of that is that we get more money on per gallon taxation, but less on those that have price triggers around gasoline consumption. And it's practically nets out. It's not like it's a big change, but it's something that we review every time we do the forecast, and it's a shift. We'll watch it closely and see how dramatic it is, but EV sales are way down, as might be expected when you withdraw subsidies, and gas vehicles are replacing those. Yeah. Lottery revenue got a little bit of a downgrade. There were 2 big jackpots in excess of $1 billion, but we didn't seem to benefit particularly from them. So there's a little bit of a downgrade to lottery. That's the only thing in the education, but it's not huge dollars, but as a percent, it was off by more than most other things.
Do you want to talk, Tom, a little bit about the risk matrix on page 18?
Yeah, I mean,
It's
there's,
always an interesting thing. See what we can do.
It's one of my favorite parts too.
We had this right before the pandemic, and the pandemic wasn't on it. Nobody thought about
Well,
it.
there's a really big dot for things that no one thought of.
Right.
well, either that or they thought likelihood of risk was
Right.
below the line on it, so it wouldn't show. But,
That was the one time we got a little caught.
but it would be way over on the severity thing, but
Yes.
also,
At this
you
point.
know, look, yeah, no, you don't, a lot of things you can't see and don't see. And so we could get hit again with all kinds of who knows what
Right.
might happen. But yeah, these are things that are, you know, kind of recognized. And here's one that's a little bit prescient, says Fed loses independence. And there's, you know, the escalation of that just a few days ago was really incredible and counterproductive in many ways. Every living Fed chair wrote you know, there's a statement they made afterwards endorsing Chairman Powell's response. But there are real costs to that. It's not, yeah, it's not a joke. It will make U.S. debt much less desirable and much more expensive. And we're already paying 15% of the federal budget on interest payments for the debt. And we are deficit spending every single year, whether the economy is strong or weak. Typically, you would ideally only do deficit spending when the economy was weak and you're counteracting a downturn. Now it's just kind of a feature. You'll see the charts on the U.S. debt that are back here. There's more red on that than the corporate profit chart. But it's you know, just reaching staggering proportions, about 123% of GDP. And nobody knows exactly where a tipping point might be, but it will get more expensive. A lot of it's held overseas. 30% of the debt is held by foreigners. And when we can't float debt or we need to pay more interest in order to have that debt to service it, that becomes a real drag on the economy. And so that's a meaningful concern. But losing Fed independence directly impacts long-term interest rates. A lot of these things aren't quick. It's not like you lose it overnight. This is a slow chipping away and erosion. You saw, first of all, intimidation to have board members pushed out for minor issues involving a mortgage application. And, you know, when there was a board member who wasn't even on the board when this transgression apparently occurred, and it's being heard by the Supreme Court now. But criminal charges against the chair of the Fed for cost overruns on a building project. I mean, really, how many building projects have cost overruns? And it's clearly designed to pressure the Fed to get political response to rate reductions. And a Federal Reserve that's responding to that kind of pressure puts us in the league of Turkey and countries like that. Yeah, that's really problematic. Stock sell-off. Yeah, go
We did
ahead.
have a question over here.
Okay, Mike.
Tom, thanks for all this. Federal debt is at about 38 trillion right now.
Yeah, roughly.
And you said, we're not sure where the tipping point is for this country. Have there been other countries that have gotten into that zone where it really shut down their economy because of the amount of debt?
Well, any sort of country that doesn't have a really big economy and a powerful military would be in tatters by now. So if, you know, Greece or something like that, yeah, this would be already catastrophic. But Japan has debt as a percent of GDP at 200%. And that hasn't collapsed. A lot of that's held domestically. It's hard to know where the tipping point might be. But just to service it, when you have to pay that much, it starts to crowd out other things you want to do. And having that much debt also does raise interest rates because it also crowds out private demand for that debt. So, yeah, there's a cost to it, but it's hard to know. If it gets to crisis point, that's different. Then, you know, that's something,
Is it because we can just keep printing money?
well, we can print it, but there's the expectation that we could grow fast enough or tax highly enough to be able to repay the debtors. So there's a lot of confidence that one way or another, we would be able to repay it. But if we repay it by monetizing it, by having really high rates of inflation and then paying it back in reduced dollars, that doesn't make people happy. And if the Fed is just lowering interest rates, you know, on political whims, then you're going to get more inflation because you're going to get a lot of demand, and they're not going to respond to the inflation, and you're essentially going to be paying down the debt by monetizing it in that way. Debtors don't like that any more than a default. You know, that's like a partial default.
So I have Lynn and Wayne, and then Jim, did you have your hand raised?
Yeah.
Okay.
Yeah, thank you. You're talking about these are national events that you're doing, are national events. Do you get down into the granular part of what goes on in the state? Because we have obviously a pension issue that we have for our teachers and state employees, public debt that we are obligated to pay. We've had to create a payment system that's going to go on. It's not going to be cheap.
Right.
And you know, to get into that and also look at the other obligations we have with the bonding that we have. I know there was an attempt by the former treasurer to go and reduce our bonding because she felt it was other people apparently also thought it was too high. Do you get into that state level kind of debt as well?
Yeah, I mean, I'm on the Capital Debt Advisory, Affordability Advisory Committee, and so I look at that information. And pension funds are now being included in rating agency consideration of state debt ratings. And yeah, that's a big issue and needs to be paid down, and it's a huge challenge. There really wasn't proper analysis at the time when these assumptions were just sort of carried forward blithely year to year with no true up when they were clearly not going to be meeting those assumptions. And so it got pretty far out of hand, not as far as some states, but still it's a big number. The recent guidance on debt issuance has been quite conservative, I think, and appropriately so. So it's, you know, the state's debt rating is maintained in a solid area. It could be a little bit better, but it's certainly, you know, among the better states. It's not top, but it's one step down from that. But yeah, that's something that needs to be kept in mind. We were talking about that this morning with what level of, you know, so the interest payments are really high because we have these high cash balances in the state. I think there's a chart showing cash balances that would be like page 14. And that's what we're getting all this interest income from. A lot of that's federal money that then is going to be spent and obligated. That's why it's going down. It's going down just about the rate that we thought it would. But the treasurer's thinking it will stabilize somewhat above $1 billion, which is higher than we've had before. But, you know, the question was, what level would be optimal? And that's probably something to start thinking about ahead. And if there, you know, can be legislative guidance on that, that would be helpful. But rating agencies love to see capacity in case things get bad. And their rainy day funds and things like that, actually the rainy day funds in that cash balance, because it's cash that's around. But, you know, those are valid questions and should have legislative input.
So we have Wayne and then Jim.
The federal debt's been increasing over multiple administrations, presidential, and Congress has been empowered by both parties during this period of time.
Yeah.
Without any correction at all.
Right.
So have you met with DC or spoke with people that, what's the thinking? Are they thinking here that we're going to deal with this by inflation of the dollar?
It's amazing that there really isn't even conversation that you hear about,
Somebody has to have some concept of asking questions about.
you would think, I mean, they're people whose job, the Office of Management and Budget, right? And, you know, it just, the political will just seems to be non-existent.
Unless they have a plan.
You know, it's always whatever the other party wants to do is too much because it's deficit spending. But then when they're in charge, it's okay for whatever it is they want, whatever their priorities are. It's a conundrum because it allows it to just kind of snowball. And there's not really, I don't see a political check right now. I mean, there's no strong, loud, politically powerful voice that's really arguing for kind of a sane plan. You know, maybe phase into something or whatever, but, you know, the Reconciliation Act, one big beautiful building is, you know, it's adding billions of dollars a year. It's deficit financed. And you can like all the things that it does, but you're borrowing to do that. And it would be better to find, especially when the economy is growing and things are not bad, there's not some crisis. I think too, the reaction around the COVID, in retrospect, people will see that a whole lot more was pushed out the door than needed to be. And the inflationary impacts of that and others are you know,
Unless we're borrowing from somebody that we don't intend to pay back.
yeah, right, our grandchildren and, yeah.
So Jim, you have a question. Just know we're going to be here till 2, so we have about 12 minutes.
Question, Tom, but on the dots on the matrix, the placement, I would guess, and you can correct me, is maybe hopefully mostly empirically based, but somewhat subjective.
Yeah, there's a lot of subjectivity. And this is Moody's. And,
Okay.
and the reason, Moody's Analytics, not Moody's the credit rating. And, I mean, it's the same company, but Moody's Analytics is a economic forecasting. Moody's acquired them. They were an independent economic forecasting entity. And so we use some of their model constructs, both at the state level and the US level. And so because we're using a lot of their assumptions in the macro forecast, I put their risks down.
That's good.
Yeah, so that's where it comes from.
Thank you, makes sense,
Yeah.
to the extent it does.
Yeah, no, I think looking at it, I just see there are a plethora of risks. There's a lot of things that go wrong, and that's always the case. But they're just things to be tuned into. So when they start, we can say, all right, that could be really impactful. Stocks by a lot of traditional measurements are overvalued. Might it drop? Okay, but it hasn't yet. Still, like, keeps going up and up and up. But often with bubbles, that's how it happens. It keeps going, and everybody wants to be the last one in, but sooner or later it can go down. I'm not saying it's going to happen, but yeah, that's a risk. But it's just a way to kind of organize thinking around those.
Charlie, you have a question?
Thank you, Tom. I'm wondering about the child care tax revenue. You have it in a couple different pages. And I think there was a problem with initial compliance with the new legislation that we put through. And there was a delay, I think, in the filing last year in terms of the filing because of people that are self-employed and trying to figure out where it is. Just how confident are you in that bottom number? And is it a matter of compliance is fully there, or what's going on there?
Yeah, I think we have actual data from 1 year, which really helps when I say how confident we're going to be, because we can look at personal income withholding, we can look at what actually did get paid, and then we can recalibrate. So whatever compliance was, it will probably improve a little bit, but whatever it was, that's what we're assuming, and we're going forward. I don't know how much is enough. I don't know what the demand is on the use side of it, because we're just looking at revenues. Is there an issue with that, or has it been plentiful enough?
Well, that would be the next question, and I wouldn't expect you to answer it, but I was just trying to come up, try to understand the reliability of that source.
I think that's
There's
pretty
some-
solid.
Okay.
Yeah, because it's based on withholding tax and then prior experience. Before we even started, it was a pig in a poke as to how many
Yeah,
employers would pay what share and all the rest.
right.
And then tax has been able to go after question mark entities that didn't pay anything that they think ought to have something, and, you know, it gets improved. So based on the latest information, we're just taking it right off our personal income withholding forecast, and that's dropping down. The way it lands in the Schedule 2 and stuff is very complicated, and I won't really go through that, but we make an estimate for what we think it's going to be, take that out each month, and then at the end of the year, do a big true-up and transfer out. But hopefully, it'll be close, but it's based on hard data instead of speculation, so that's better.
Thank you.
Rebecca?
Thank you so much. And you mentioned this in the report, but some of the data collections nationally have been compromised or discontinued.
Right.
And how is that going to affect your ability to forecast? And are there regional efforts to come up with other measures that might support good decision-making at the state level?
Yeah, there's a whole page, that's also page 27, and the bottom of it's a little bit blurred because it's a long list of all the data sources, select the data sources that we use that have been delayed or compromised or canceled. And for people that live on the numbers, I mean, when we do the forecast, we try to first run the numbers and just say, what are the numbers telling us? We don't put any priors on it, any expectations. What is the data saying? Revenue data, the economic data, all the rest. When we don't have economic data, we're like, you know, okay, what did it say in September and August? And that's all we have. So it's not as good, not as accurate. And then some of the calculations, the methodologies going forward are compromised as well. The CPI, which is like a cornerstone measure of inflation, they skipped October, so October will never be out. But the shelter part of the CPI, which is a third of the CPI for housing and shelter, is done on a 6-month rolling average. So October ends up being a 0 and no change. So you're dropping a 0 in an average of 6 months for 6 months. That's going to create a little downward bias.
That's not good statistics.
It's not good statistics. And
You could estimate based on previous ones.
well, you could look at other studies, you could look at other things. Actually, I think there are probably a lot of ways with big data. They could digitally collect information that would be more extensive and probably better quality. You know, but the money, they proposed doing some of that, and it's never been funded. So for them to change off it is also a big problem. Yeah, no, you could have estimated it. You know it's actually very unlikely that it's 0. It's very unlikely that it's negative. Just look at the history, you know. So it's probably somewhere between, you know, 1 and 4 or 2 and 4 even. It's probably close to 3. The things before it and things after were all 2.7, 2.8, 3.0, you know. That would be better to plug that in. They didn't want to be accused of making up numbers, so they just sort of said, it's a blank, it's a 0, we do it. And they were transparent about it, so anybody that doesn't like. But to your question is anybody trying to do anything about it? Some of the national forecasting firms, like Moody's, are developing some of their own estimates and using those to try to fill in the blanks. Regionally, I don't know anything that's happening on that. It's equivalent.
What else would you like us to know in the remaining few minutes?
Well, if there are any other questions, that's really what it's about. I don't think, you know, there's all kinds of details, sub-details, things in here. And if you have questions, you know, that come up after looking at it, feel free to contact
I'll
Joint
ask a
Fiscal.
question then.
Okay.
You know, you talked at the e-board about immigration policies and workforce and not necessarily having an effect. But, you know, in Vermont, we have a lot of dairy and other things where we use immigrant labor. And I'm wondering if you're noticing anything specific to Vermont related to our workforce, if that's impacting us here.
Yeah, I mean, the ag sector is so small as a share of the total.
Yeah.
It's not like that leaps out
Yeah.
in a state with a diverse, you know, and larger economy. It's not to say it doesn't bring stress in particular areas.
Yeah.
Healthcare has been another one
Yes,
that has suffered with that. Elder care,
yes.
personal services, things like
Yes.
that, have really been impacted. Construction, not as much here as in some other states, but still, yeah, there's sectors that have been really impacted, and it's impacted price. What?
Colleges and private schools might also be impacted.
Colleges and private schools?
Yeah.
International student.
International.
International, yeah, you know about that, right, yeah.
I just heard that the administration is going to be revoking or sending back like the 250,000 or so Haitians that were here that came after the 2010 earthquake. I just read that today. Did you see that?
Yes, I did.
And those folks are often their caregivers.
Yeah. Oh, you go to a nursing home, or you
Yeah,
have an
or hire
elderly
somebody
relative.
privately or
Yeah.
whatever, yes.
Oh, they,
That's going to have a huge impact.
yeah. And they are good people. I mean,
Yes.
they, honestly, the care that I've seen from the immigrant community to elders has just been extraordinary, yeah. Yeah, no, and very hard to replace. So, yeah, there are real costs to demonizing that segment, and in higher education, it's not just a loss of money, but also influence that the country can exert, and also talent that stays. And, I mean, the long-term costs of a lot of these things, they didn't show up right away, but they're real and meaningful and will not be helpful.
Woody,
I
go
have a
ahead.
question. I just mentioned it to my colleague here. With everything that's going on in our country right now,
Yeah.
America has been looked at as a place of stability. Is America still a good place to invest in? How does the outside world look at investing in America? And how might that trickle down to our state as well?
Yeah, that also has a long-term, short-term component. So the rule of law is really critical for investor confidence any place in the world. When you make contracts that you need to make in order to run a business and build stuff and invest, you need to feel like it's going to be impartially adjudicated, there's not going to be money under the table, and all the kind of stuff that happens in many, many other countries in order to get something done. To the extent that the judiciary is not independent and is being yanked around for, you know, political favors and various things like that, it will undermine that confidence. And again, it's the sort of thing that happens gradually. It's not like just all of a sudden it's there. But there's a lot that's going on that is suggestive of that kind of control. There's a desire for, you know, politically controlling that, what should be an impartial process. And that's degrading. That will have high costs. I mean, the benefits we get from these institutions and these norms is enormous. And they're easy to tear down. Maybe they're not easy, but they're easier to tear down than they are to rebuild. And there's a high cost to that. It's troubling, yeah. Yeah.
Rebecca?
That was, actually, I was trying to build on that same question. When you think about the K-shaped economy that you're
Yeah.
talking about, you know, to the extent that it's increasingly financialized, it's also more liquid and it can move across borders more quickly too. Is there growing risk just independent on our tech center? Because it can also be moved out of the United States more quickly?
The tech center?
I'm looking
Oh,
at
our whole tech sector,
sector.
okay, the tech sector,
Yeah.
got it. Well, I think you'll see it like, so the investments in research and development money to universities has been drastically reduced. China is doing the opposite and has been for some time. Their rankings recently published of the top universities in the world based on research papers that are produced, based on, you know, frequency of citation, patents that have come from all the rest. Really, in the top 10, 8 or 9 are Chinese universities now. There's 1, maybe 2 American universities that are in the mix even. And so, yeah, you can lose dominance in a field. I think the combination of, you know, commercializing that research and development is another step. And the United States is set up with a lot of capital and, you know, all the Silicon Valley investors and all that. It's been a very fertile place for that to be developed and then manifested in market applications. Again, it will take a long time to lose all of it, but you lose pieces at a time, and it will become less and less attractive. You won't have the same personnel. Look at some of the tech companies. Who started them? So many of them were started by immigrants that came in, people that came in, went to school here, or just came here and started these entities that are now generating millions of dollars in taxes to Vermont. Not just billions there, but many millions of dollars that we get in tax revenue from these companies. So it's a real loss. It really is.
All right, I think we need to wrap up. So thank you so much for coming on that cheery note. But I guess the good news is that with all the chaos, we're still basically at least neutral, and that's a good thing. So
Heading into the year where...
yeah. So we thank you for your time. Appropriations, if we can go back to our committee room just for 5 minutes to check in after this, that would be great. Do you have any directions for your committee? All right, happy Friday. Thanks so much.
Thank you all.
Thank you.